Oh, good morning, good afternoon, or good evening, depending on your perspective on the world, and welcome to Trading Coaches Playbook. My name is Brandon Waddell, and I'll be your host for the next hour as we kind of dive into what's going on in the markets and talk a little bit about how to deal with volatility in the market. So I want to welcome everybody here. Good afternoon, Kevin, and welcome. So before we get started, just need a quick reminder that we are not broker dealers or investment advisors. Going to look at this information, but from an educational standpoint, I'm not telling anyone to buy, sell, or hold in particular securities. It can make personalized recommendations about the markets. Keep in mind that all markets do involve risk of loss. There's always a situation, no matter what we do. We can only minimize the risk. We can never eliminate it. And we are also not subject to trading restrictions. So we could have a position in a security or initiate one at any time. So I just want to welcome everybody here. And like I said, we are pretty busy. We got a lot of things going on, as you can see, a lot of premium online workshops. We got a big one coming up called Trading U, which is basically a lot of, well, all the presenters are going to be sharing some of their knowledge with the students in that Trading U. So if you want more information on any of this, obviously you can contact us. Morning, Stephen. Welcome. I am pretty busy myself with the program called E-Mini Think Tank. That's where I spend the majority of my time here for Wealth Builders HQ. And basically what we do is 3 times a week, we focus on what the futures markets are doing. So it's a combination of education and trading ideas when it comes to the markets. I'm just going to go, let's see here, not logged in. Oh, no, I am logged in. Let's see. Hopefully it works. Yep, there we go. Oh, no, it's not logged in. So let me log out and log back in. This is the main student page as I log back in just a moment. And Lee has already added the link there too. So if you wanted to kind of check it out and kick the tires, if you will, on the E-Mini Think Tank, you can. We do a 2-week free trial if you do a quarterly subscription. So you have the choice of either monthly subscription or quarterly. And with the quarterly subscription, there's a no questions asked 2-week free trial always offered. So that's kind of cool. But when I go into the E-Mini Think Tank, it is chock full of information. So if you're relatively new to trading futures, it may seem a little overwhelming. There's actually another program that can help you called the Futures Boot Camp. Let's see. Yeah, right there it shows Futures Boot Camp. That's for people who are brand new to trading futures. Maybe you traded other assets. Maybe you never traded before and are interested. You can go into the Futures Boot Camp and basically see what futures are all about, how to trade them. And then when you're ready, you join me in the E-Mini Think Tank. We do 3 sessions per week of live analysis. So we meet on Monday, Wednesday, and Thursday from 9 a.m. to 11 a.m. Eastern to basically identify what's going on in the markets and see what we might be able to trade. And then in addition to that, there's tons of education. So we have these bonus videos where you can learn things like Elliott wave, seasonality, how to scalp futures, how to identify trends, and so on. So a lot of information there, as I mentioned. But getting back to what's happening here, oops, bear with me a moment. Okay. I'm just taking a look at the ES right now, but actually what I'm going to do is create a Word document for us. Actually, I think I have Word open already. So I'll get just a new blank document here. And the topic of today's discussion is how to deal with some of the volatility that's going on in the markets, the high volatility. And come on, what did I do? There we go. It's just trying to enlarge screen so we'll be able to see it better. There we go. So dealing with volatility, and really what it comes down to is risk management. I can probably guess the answer, but how many of you, show of hands if you want, or say yes, how many of you enjoy losing money? Right? You probably weren't expecting that question. Most people do not enjoy losing money, right? And part of what we do when it comes to trading is manage our risk so we don't lose money. And if we do lose money, lose very little, right? I've been doing this for over 25 years. So it was also a pretty good guess that most of us do not enjoy losing money. Now, if I ask how many are good at it, there might be a different answer. But as far as enjoying it, no. So our job as traders obviously is to grow our capital, but we need to do it in a way that we are not taking unnecessary risk. And we have to also identify the risk that we are taking. And one of the things you can also look for when it comes to volatility, first of all, maybe we should define what is volatility. Let me go ahead and there we go. Well, volatility, I mean, I'm not going to go through a classic definition, but basically it's price movement. It's the expectation of prices to move away from the norm. How much of a wiggle are we going to get every single day? So one way that we can measure volatility would be to look at something called the average true range. So ATR, or average true range, is a measure of volatility. And on most platforms, you have that available. You actually also have volatility as an indicator as well. So you can see, sorry, I was checking something here. Okay. Anyway, so you can kind of see when volatility is gaining or when volatility is dropping. So I'm going to go to a daily time frame here, and I happen to be, like I said, on the S&P futures. I'll go ahead and clean this chart up for now. And I'll get rid of this indicator, but bring in average true range, or ATR, as I was saying. And just to show you, I guess I can bring in volatility as well. I guess we got historic volatility. There we go. Maybe see if that's any good. I'm not sure if they have implied volatility. These are just technical indicators that people have made up. And there we go. That's what I was looking for. So implied volatility suite. I'm not sure what that is. I'll figure it out. Anyway, the top is, and I don't know why my titles aren't there. I have them erased for some reason, but the top line is what we call the average true range. Okay. I can put labels on them just so we know what the heck they are. Like I said, I don't know why it deleted my labels, but I did. Anyway, this is ATR. And ATR is a measure of volatility. As I said, it shows you what is the average range. And when we talk about true range is slightly different than range. So range is the distance between the high and low. Oops, can't spell today, apparently. There we go. So it is the distance between the high and the low of a security. Now, true range is the same thing. Oops, wrong one. That's not what I wanted. Distance between the high and the low. Okay, but true range is the distance between the high and the low, including any gaps from the previous trading session. So basically, if you're on a daily chart and you had a gap up or a gap down, the true range would also include that price action from that gap as well. And hello, Brenda, welcome. So that's the difference between those two, range and true range. So the average true range is the average price movement. And we also have two types of volatility as well. We have historic, or it's also known as statistical volatility. And then we have implied volatility. Okay. So statistical or historic volatility is basically a chart. It's past price movement. So it tells you what's already happened in the past, how much price swings we've gone both up or down. Implied volatility is expected in the future. So it's what are we expecting to have happen? Our price is going to be getting bigger and more volatile swings, or we're getting smaller swings in the future. So I can use the ATR as a way of looking to see what is the current price movement. It's going to be looking in the past. So it's really the statistical or historic volatility that we're reviewing there, not looking forward. So again, if I look at my ATR, what do we notice about the ATR right now? And again, I'm just looking at this one indicator right here, this upper one on the S&P 500. Well, we can see that it's going in an upward direction. What does that mean? Volatility is increasing or has been increasing. Doesn't necessarily mean it's going to increase in the future. But currently, we are seeing more movement, if you will, between the highs and lows of all these candles. So we're getting more price movement and therefore more volatility. Well, more volatility is not necessarily a bad thing because it can also increase the potential profits. But anytime you increase profits, you are also going to be increasing risk or potential for loss in the markets. So you must be careful. It goes both ways. This was, I believe, oops, what did I do there? Yeah, that's historical volatility. So this is a measure of the previous volatility. It doesn't look as extreme, but it is getting a bit higher. I'm going to go ahead and remove that anyway because we have ATR. And let's see. This is implied volatility, I believe. Not the best indicator the way it looks right here. But again, implied volatility is what we're expecting to happen in the future with the price movement. And you can see it is kind of increasing as well. So we're getting an increase of potential price movement going forward. So if we have increased volatility, what that means is bigger price moves. In the future. And that kind of translates into larger profits on the good side and larger losses when it happens. So going into our risk management, I've talked about this before. I've actually done sessions on risk management. Really what it comes down to, that's the only thing within your control in the markets. You can't control whether the markets are going to go up or whether the markets are going to go down. If you can, please let me know. Let's talk. We can make a lot of money. But for the most part, you cannot control which way the markets are going to go, either up or down, right? The markets just do what they're going to do. And we can't control how much we're going to make. To a certain extent, we can control a little bit of that. Increased volatility in the direction of movement. Good question. Not necessarily. No. Remember, when we're talking about the average true range, we're saying that it is the price movement between the prior close and the current high and low. Now, I happen to be on a daily chart, so that would be this close from yesterday, today's high, today's low. But if we take a look at, say, a 15-minute chart, that's the average true range from the prior 15-minute candle and then the current candle's high and low. So what happens if we're getting increased ATR and increased volatility, it doesn't necessarily mean that you're going to get more movement in your favor. Generally, and it's not exact science, I probably could measure it and I just haven't, but overall, in a strong trend, usually 60 to 80% of the ATR would be with that trend. We don't get 100% of the ATR in our favor because if we did, we would have solid green candles with no wicks or solid red candles with no wicks. And you don't see it on a chart all that often unless you're losing money, right? No, but normally, you take a look, for instance, I'm looking at a 15-minute chart, and let's just talk about the movement from, high to where we are now. And originally, you can see we were about 5.5 points. Now we've gone up to about 8.5 points of ATR. What that means is, back here, when I first started looking at this, if our ATR was about, we'll call it 6, make it easy. If our ATR was 6, then we should expect between the high and low of each candle 6 points of price movement. Now that's the average. It doesn't mean that every candle is going to be 6 points, right? It could be more, it could be less. But remember what I said, typically by the end of the candle, you should only have about 60 to 80% of that price movement in your favor, in the favor of the trend. So let's say we go for this candle in particular. We have a close right here at 4,400. That means that when prices move up, if the ATR is roughly 6 points, we should see a move up to 4,406. Well, look at that. We went up to 4,407, right? And then if we look at 6 points times, let's say 0.6, that's 60%. That would only be about 3.6 in our favor. So 44,036. Well, let's see where we closed. A little bit below that, 44,02. So we didn't even get 60% in our favor, but that's because the trend was kind of dying off. But what we should have expected, I say 36. So right about there is where we should have ended up closing if this trend was continuing. And as you can see, it died off and went less. Now we go forward, this candle, and we're going to measure from the close of the candle. Let me change the color so I know that's the close. I'll use that one, it's fine. So there's the close of the current candle, and the ATR at that time is about 6.25, we'll call it. So from that close, 44.02, and actually I said it was 6.25 roughly for the ATR. Let's say we do 80% of that. That's only 5 points. So we should be going down to 43.97 and closing there. Well, obviously we exceeded that because we had a pretty strong move to the downside, right? So went way beyond that, went more than 100% of the ATR. But my point is, from the prior candle's close, typically, if we're moving in a strong trend, you should expect anywhere between 60 and 80% of that ATR movement in that direction, and possibly a close near there as well. Now, I'm not going to bother measuring every single candle, but just gives you an overall idea of how much volatility you're facing in the markets. Okay, so in a strong trend, usually you get not 100%, but a lot of the ATR in your direction, in your favor. Now, when it comes to risk management, as I said, that's the only thing we can control. So we can only control how much we're going to lose if we are wrong when we're trading at any market. It doesn't matter if it's Forex, futures, stocks, it doesn't matter. That's the only thing within our control. Oops. I was trying to enlarge this thing's away. There we go. Can I move that? Nope. There we go. And like I said, there's only a couple ways to manage the risk. Basically, number one is size. And I'll go into the details of this as well. Number two is frequency. And number three is duration. And I'm talking about trades. So I can't remember where I did this. I know I did a session previously. You can go back, actually, if you go out to YouTube and look for our Wealth Builders HQ YouTube channel. See if I can find it pretty quick. There we go. And if you go into playlists, pause that. Under playlists, you should be able to find, I got my E-mini Think Tank playlist, but that's not the one. Trading Coaches Playbook right there. Oops, wanted to go to the full playlist. Apologies. View full playlist. There we are. And, oh, look at that. There it is. 2 years ago. Wow, it's been a while. Manage your trade risk. So that is where I talked a little bit more about this. And obviously, when volatility increases, we want to manage our risk. We want to protect ourselves. So there's a lot of good videos here that are absolutely free. You get a lot of good information there. You got Tony, and you got Ryan, lot of different stuff. Anyway, getting back to this. So we can only control how much we will lose in the markets if we're trading live. The first one is size. And the nice thing is that when it comes to the size of these markets now, we got a lot of opportunities, a lot of different choices that we didn't used to have. You know, especially in futures, it used to be you traded the futures contracts and that's all you had, the main full size contracts. But now we have different types of contracts. So we have standard, we have minis, and we have micros. So deciding what type of contract you want to trade, the larger the contract, the more risk you have, of course, right? And I've said this before, you know, in order to increase reward, you must increase risk. Can't have one without the other. They go hand in hand. I might as well say it. So you have to accept risk if you want to get bigger rewards. So we can choose the types of contracts that we want to trade. You do need to be a bit careful though, because not all contracts are equal. You want to make sure they're liquid. So if I go out to the CME website, I'm not sure if maybe it's under data I can look for. Volume and open interest. Now, when we look at the volume and open interest data from the CME, unfortunately, they show you the previous day's information. They don't give you the current day until the day is over for whatever reason. That's just the way they go. So if I go into futures, there we are, and we could choose a certain category. Let's say we want to look at the agriculture products. Take me just to that. Used to be. I guess these aren't clickable anymore. That's weird. I can just download the data and kind of go through it real quick. Let me see. That works. Come on. There it is, opened up. No, it's just giving me overall data, isn't it? It used to be you used to click on this and it would give you the actual volume for each one. But that's okay. I can do it a different way. We'll just go to markets. Let's do something like corn. And we can even look at volume or just quotes, either way. So I can see, this is the individual corn contracts. We got December with 89,000 contracts, 27,000 for the March, and so on. I could also look to see, I'm trying to remember where it is now, because it used to give you a full list of everything. But right here, I can go and see what contracts are available for trading. So when we look at corn, you'll notice there's corn, mini size corn is available as well. And I don't think there's a micro corn. Nope, doesn't look it. Anyway, if I go to mini size corn, we had about, was it 80, 90,000 contracts traded on the full size. Look at the mini corn though. We only have 900 contracts traded. So one of the things you definitely want to be careful with is when you are selecting securities to trade, especially in futures, because that's what I focus on a lot. If you are day trading, there needs to be liquidity. You need to be able to get in and out. So you want to see a minimum volume for day trading of probably greater than, I'm trying to see a good cutoff. 5,000 is an absolute minimum, but really you're probably looking at a minimum of, I'll say 10,000 contracts. If you start going under that, where you don't have as many contracts being traded during the day, it may be difficult. Yeah, that's the whole day so far. This is actually showing you what's happened so far for the day. So if we were to look at the contract longer term, or right here, volume and open interest, excuse me, now you can see that yesterday, the 12th, we had volume of 2,100 contracts for the entire day. But yeah, it's pretty light volume altogether. So my point is, on this particular mini corn contract, first of all, if you were to go to the charts, it probably wouldn't look very good. But secondly, you could get caught where you couldn't get out, or couldn't get out at a price that you wanted to get out. Let's see, it's XC for this contract. Let me see. We chart it. And here you see this is a 15-minute time frame. Chart's okay, but notice all the gaps that are happening intraday. If I go to yesterday during regular trading hours, same thing. You got these intraday gaps, right? Still under a metric. Yeah, it is. Hopefully, like corn, because it'll get delivered to your house. No, actually, it won't. Most brokers will not allow you to get delivery for these contracts. What they will do is prior to the delivery or first notice date, or the expiration date, whichever comes first. First notice date is the date that you have to let them know you want delivery. The expiration date is the end of that contract's life. It can't be traded anymore. But most retail brokerages will automatically close out your position if you fail to before that date. And you'll get notifications. If I go out, say I want to use TradeStation, for instance. Oh, shoot. No, I don't think there's any. I'm sorry. Hold on a second. Okay, so let me log in here real quick. Sorry, there's something going on. But anyway, like I was saying, that if you have a position, let's see, hasn't popped up yet. There it is, message center from TradeStation, open. And what will happen is before the expiration, you'll get an email, usually if you have an open position, but typically before that contract expires, or like I said, the first notice date, you'll get a notification. So right here it says, there's extra volatility. That's not the right one. Right here, maybe this one. Yeah. Zoom in so we can see that better. First notice, last trade date for the following contracts is Friday, September 29th, 2023. These contracts are physically deliverable. And it shows you the list. And it says, please be sure to roll or offset positions by the close of business on Wednesday, the 27th. If you don't do it, the position will be liquidated by the trading desk and the account will be restricted, which basically means if you don't do this, they will close out the position and you will not be able to open new positions for 90 days. And maybe 60 days to 90 days, depending on the brokerage. You'll be able to close positions, but you can't open new ones if you fail to do that. So obviously you want to pay attention to those notifications as they come up. And they usually give you plenty of time. This was a notification on the 26th of September for the 27th, but I can almost guarantee that before that happened, they had other notifications. Yeah. But no, they don't want you getting caught with a bunch of contracts being delivered when you didn't really want them. So anyway, where was I here? Any minimum volume for day trading, you really need about 10,000 contracts. That does a couple of things. One, it ensures that if you need to get out of your contract, whether it be buying to cover a short or selling to get out of a long, that there's somebody there to trade with you. You can get out easily. Okay. And secondly, the spreads will be better. If you go back to the quotes on mini corn here, for instance, I'm not sure if it'll show me bid ask. No, it just shows me the last price. But if you look at the bid ask spreads, the lower the volume is and the lower liquidity is, the bigger the spreads will be. So in choosing the right contracts, we definitely want to make sure that we have liquidity and a good trading security. So again, let's go back. This is XC. If I did ZC, which is the actual corn, notice we still have a little bit of intraday gapping, but a lot better chart altogether because there's just a lot more liquidity, a lot more volume. This had 90,000 contracts versus 900 contracts on the micro or the mini. So you just want to make sure you're trading the right contracts. So we can reduce risk, but we can only do it on certain securities. You can't do it on everything. If you are doing a long-term swing trade, actually, you know what? I'm probably going to raise that to 20,000, honestly. But here, if you are swing trading, you can be a little more lenient. You can actually go all the way down to 5,000 contracts as far as the volume goes. So you don't need as much volume because you're not getting in and out as quickly. You're looking at a bigger picture move in the markets. So a little bit more breathing room, if you will. So when it comes to risk management, you're trying to choose the right securities to trade. You want to make sure you choose the right ones. Hang on a second. Yeah. All right. So where was I here? Sorry, I got sidetracked. I'm getting some messages for something else. So yeah, like I said, we could have the liquidity as long as we have at least 5,000 contracts for swing trading. So, like I said, there are some contracts that are out there that offer you plenty of choices. Let's see, markets, no, euro, for instance. If we take a look at the euro, going into quotes, there we go. Get that. You can see that right now we have 155,000 standard contracts for the December being traded. Well, if we take a look under Forex, we can go to mini euro. And again, looking at the quotes, well, we only have 3,500 minis. So that's a bit of a problem, right? And we can take a look at the average volume for that as well. If I go to volume and open interest, there you can see that the average volume for this is quite low, under just barely 5,000 on that day, 4,500, 4,200. So it doesn't look like this is a good swing trade candidate either, looking at the mini. And then if we change over to the micro, you'll see why people actually skip over the mini and they trade the micro or the standard contract. And here you see volume 27,000, 25,000, and so on. So that one is okay. As I was saying, if we go into 6EZ 2023, this is the full size. Oops, didn't go. There's the full size euro contract on a 15-minute time frame. Chart looks good. Spreads will be pretty decent. But if you go into, say, E7, yeah. There's the mini contract. Actually, the chart doesn't look too bad, but again, the volume is not great. And then 6E, there's the micro. And again, you have good volume and good open interest. Can you combine the open interest of volume? No, you cannot. Volume and open interest are two different things. So you cannot combine them to get the minimum number required. Okay. So it's either, volume or open interest. Open interest shows you how many contracts are actually open and in existence. Volume is how much have been traded during the day. So no, you can't combine the two because they're completely separate in what they actually represent. So size, like I said, is one of the things you can look at, and you choose what types of contracts you want to trade, and also how many of those contracts you trade. So of course, once you've chosen what it is you're trading, you decide how much of it you are going to be trading. You choose the number of contracts to trade. And of course, more contracts is greater risk. Fewer contracts, fewer risk, or lower risk, excuse me. So that's another thing you can do. Now, frequency is the number of trades taken. Basically, we need to be selective in our trading. We want to be kind of discriminatory and only take the best trade opportunities that are out there. Okay. So, every trade that comes along is not a good thing to do. We want to take just the best of the best, because anytime you take a trade, you run the risk of taking a losing trade. So we want to be selective. Open interest can only go down if exercise and maturity date is reached. No, not exactly. Let me do a quick explanation of open interest, because that is important to understand. So volume is the number of contracts traded, period. And that includes a long and a short. It doesn't matter, because somebody had to buy and somebody had to sell. Now, open interest is the number of contracts in existence. So obviously, if you create by buying a new contract, so open interest increases from a couple different ways. Someone sells, basically writes a new contract. So sellers are also known as writers. Actually, yes, I can this document, I will save this. So let's do this. Save as risk management notes. And I'm going to put it into E-mini Think Tank. No, I'll just leave it in that one. E-mini Think Tank, risk management notes. So what'll happen is, if you decide to join me in the E-mini Think Tank, under the members area, there'll be bonus videos and recordings, things like that. But there's also documents, and it'll be in most likely the miscellaneous documents right here. It might be under fundamentals. It should be under fundamentals. But yeah, I'll tell you guys in class when it gets posted. So if you join me in the E-mini Think Tank, you'll have access to all these notes that I'm putting together for you as well. So thank you, Ellen, for asking about that. So anyway, open interest, the way it increases is that somebody creates a new position. And when you sell a contract, you're actually writing a new contract up that didn't exist before. So somebody is selling a new contract to open a short position, and they sell to a new buyer, creating a long position. That's how open interest goes up. Actually, let's do it this way. Open interest. Get creative with the notes here. Now, open interest, and this would be kind of neutral, there can be an increase in volume for this too. Let's see. Someone writes a new contract to open a short position, and they sell to a new buyer who is creating a long position. During this, volume will increase. Now, how does open interest stay the same? Well, transactions can still occur, but open interest would stay the same. Basically, a trader with a long position, sells to exit, and the buyer is opening a new long position. And what's happened here is basically the interest, basically the contract, has been transferred. Oops, did I spell that wrong? So open interest can be transferred rather than increasing or decreasing. So the trader who has a long position is going to get out of their position to basically sell their contract to somebody else who wants to buy it. So open interest has been transferred, but volume goes up because a transaction occurred. So volume starts off as 0 every single day and only goes up. Open interest starts as 0 at the beginning of the contract. When the contract is first traded, open interest, or OI, put that here too, starts at 0 only when the contract is first available to be traded. Okay. However, volume that starts at 0 every trading day. The volume open interest starts at 0 only when the contract is first available to be traded. And then it would just basically, whatever the market reopens the next trading day, it just picks up from where it was and can either go up, sideways, or go down. So that would stay the same if you're selling a long position to exit, because they bought and they went long, now they're selling to get out, but they transferred it to somebody else. And the same thing could happen too if they're buying to cover, but they're buying to cover from someone who's selling the contract. So again, anytime that the contracts are transferred, the open interest stays the same. Now, how does open interest decrease? Okay. Basically, if somebody with a long position sells their contract to exit, and the person who's buying is closing a short position, I should say, an existing short position, basically both parties are closing positions. That should be and the buyer. Right. Since both parties are closing their positions, basically open interest will decrease because they've torn up their contracts. They're both closing their positions. Another way that can happen should be they're both jumping off a burning ship, maybe, or maybe they're both profiting. So that's a way that open interest can decrease. And by the way, volume will go up because transactions occur. It always has to. So let's see, what am I missing here? So closing a long. I think closing a short would be buying to cover. Same thing, basically the inverse. So that's it. That's how open interest can actually decrease, increase, or stay the same. So no, there's no exercising of contracts whatsoever. These are actually just trading the contracts opening or closing them, but it has nothing to do with the exercising of the contracts. And this works for options the same. Yeah. So hopefully it does make sense. Good. Anyway, we want high quality trading opportunities. So getting back to this risk management, we only want to take trades that have a high probability for success. And we want to filter out trades that are just marginal. And I do that several different ways. Basically, one of the ways is I kind of talk through the trade. Remember, when you're a trader, as a trader, you are judge and jury, right? So you make the decision to either trade or not to trade. So you want to weigh the evidence. Now, in addition to that, you got a lot of roles. Oh, you're very welcome. Hopefully that explained the open interest for you. Cool. So where was I here? In addition to be the judge and jury, you are also both attorneys. So you present evidence why you should be taking the trade and what are the problems with the trade? Why should you not take the trade? So you need to kind of present yourself a case. And this is what you're doing when you're deciding whether or not you should take a trade. Yesterday, there was one in particular that I was working with, I was mentoring somebody. Oh, just had it there. Hang on. I was looking at this position right here on the Russell, and it was a 3-minute trade, very short time frame. And basically, it was like, okay, well, here's kind of a weak, but it's there supply zone where prices were coming back towards. I was looking for an opportunity because the markets had dropped quite a bit already, and trying to figure out, okay, well, we got right here drop, base, drop to new lows, and prices were coming back up towards that area. And I needed to decide, do I want to sell there or do I not? Well, obviously, I would look to see how strong the zone is. I would look, and I used the RSI to help me with filtering these trades. And the RSI was saying, okay, we're fine. We can go ahead and short there. But in addition to that, I would also take a look at the big picture, the 15-minute time frame, or not really big picture, but intermediate time frame. And I would look to see, what is my trend? Do I have the overall trend in my favor? And then I even go bigger than that. From here, 15-minute, I went to a 60-minute to see, okay, well, if we are in a downtrend, where should be the end of the trend? And I present myself with all the evidence. Why would I want to take this position? What's happening with momentum? What's happening with the trend? What's happening with my zones? And I would also look to see, okay, where are the dangers? What would happen if this goes wrong? What would be the triggers that could cause me to lose money? So I worked that all out and try to figure out, is this a good trade? You don't get rich by taking a lot of trades. You get wealthy by taking the right trades. The only person that makes a lot of money if you take a lot of trades is a broker, because they either make money on the spread or they make money on the commissions. But this one ended up working out. Prices came up, hit the zone, and just collapsed. But that's what you have to do. You have to make sure you're only taking good trades. It's not a sprint. It's a marathon. We want to make sure we're consistently building profits in our trading accounts. And the last one is duration. I should say, really, this is the length of the trade. Basically, how long are you in it? How long are you in the position? And remember, anytime you're in an active position, you have risk in the markets. Period. That's it. You're taking risk if you are active in the markets. So how long are you going to be in the market is kind of a function of what time frame are you using for the charts. or I should say, it's directly related to what time frame charts you use. Typically, and this is not set in stone, but typically, if the charts are less than 60 minutes, you're likely day trading. And what happens with the day trade is you're removing overnight risk, you're reducing risk because the zones are smaller, right? So actually, I should type that in. So let's do this one. So risk is reduced, one, if you don't hold overnight, and two, on the zones are smaller on the smaller time frame charts. So you enter close to your stop loss, right? If we go out to a chart, for instance, this 3-minute chart, you can see my entry was around 1763. My stop was 1765 and a half. So I had 2.5 points of risk. And if each point is $50, that was $125 worth of risk. That's it. Oh, my dog's barking at. Now, if I take the same chart and go to a 15-minute time frame, now if I look at the zones where I'd want to buy or sell, I'm going to have bigger zones. So for instance, this one would have been a bit bigger. It would have been about 1764 and a half to 1769. So now we're looking at almost 5 points of risk. So we doubled our risk by going from a 3-minute to a 15-minute chart. Heck, if we were to go out to a daily chart, obviously the risk would be much, much bigger. But this 1 hour, 1 day. So right there, now that zone is 1793 to 1824. So we're looking at a much bigger zone and a much bigger risk. So we reduce the risk if we don't hold overnight. If we day trade, yeah, we'll do that. Just cleaning up the notes. So yeah, it's a matter of whether or not, now it's not wrong to day trade over longer term swing trading. People always ask, okay, well, which one's the riskiest? Is day trading risky or is long-term trading risky? It depends. Really, it totally depends on how you adjust these three measures of risk. Because when you look at, let's say, scalping, that is a very short intraday trade, right? So with scalping, we have size. Okay. Well, actually, the biggest risk, or I should say the least amount of risk, is from the duration. Right? Because if you're scalping, you have very low risk on duration because holding period is very, very small. Now, what will probably happen with the scalping is when it goes to frequency, you might have higher risk because you get more trade opportunities. So, how do we compensate for that? Well, we have the duration, which is low, and we can control the size as well. My point is, there's not one style of trading that's necessarily riskier than the other because you can adjust the other pieces when it comes to the risk management. So instead of scalping, which is very quick, if we do day trading, well, duration, again, is very low risk, or relatively low risk, I should say. And we eliminate the overnight risk by day trading, right? Number two, again, we may be a little bit higher risk because we do see more opportunities intraday. And of course, we can actually control the risk from the size selected. Well, next we might have some swing trade. And with swing trading, duration is actually medium risk. It goes up. Basically because you're holding overnight or over the weekend. So there may be times where you're in a position where the market is actually closed. So you're definitely increasing your risk over day trading. Well, how do you control the risk? Well, frequency is one. You might find fewer trades than when you're day trading. And of course, we can control risk from the size that we select. So you can compensate, even though you have higher duration risk, you can reduce the risk by using other pieces, as I was saying. And then position trading, you got the greatest risk because you're holding the longest period of time. Like Amelia, you get hives holding overnight. Some people hate it. Yeah, you can't take the risk, so you avoid it. That's not a big deal. With the frequency low, because you have fewer trade opportunities, and obviously because we have high duration risk, we can actually control the risk from the size selected. The size is probably the easiest thing to adjust. Oops, that's so size. There we go. And that's probably the best way to control the risk. So when somebody says, okay, what's the most risky way of trading? It could be any of those. It doesn't matter. It's how you adjust the risk. And if you're having a smaller period of time, maybe you take more trades or you use bigger size to make money. Meanwhile, if you're doing position trading longer term, you reduce that size, you reduce the number of trades because you've increased your risk on the time frame. So it's completely up to you how you want to manage that risk and deal with that risk. So when it comes to high volatility and increases in volatility, let me go back over to this. I started off talking about looking at big picture and the average true range, right? So we look at the average true range right now, and actually we can go all the way to weekly charts if it lets me here. Let's go full size contract. Well, you know what? I'll do continuous. There we go. So we look at the volatility right now on the euro, we see it's actually down. So if we're getting less volatility, less price movement, we could possibly increase the size to take advantage of that move. We can adjust our risk to compensate for that. But if the volatility starts going up like it did back here, you do just the opposite. You turn down the risk dial. Maybe you hold smaller time, maybe you hold smaller contracts, or you be a little more selective in your trading. But that's how we can deal with this volatility that comes into these markets. If I look at the S&P futures, overall, we actually have a little bit less volatility than we've had historically in 2022, but recently it's been ticking up. You go to the daily chart, and there you see the volatility it's increasing. You take a look at the NASDAQ, same thing. I'll go to weekly chart. Overall, our volatility isn't too bad, but in the past several weeks, it has increased and been giving us some spikes. So to compensate for that, again, we just changed the style of trading that we're doing. You know, you don't necessarily have to go from being a position trader to a scalper, but you can adjust pieces in between. And the only way to adjust that would be one of those three things right here: frequency, duration, or size. And that's how you deal with volatility. So if you want to get more information on that, you know, I went over quite a bit, as well as get these notes dealing with volatility. As I said, what I'm going to be doing is including this in the fundamental documents for the E-mini think tank. I'd love to have you jump on board. We get the link put up again in the chat. I know it was in there just a little while ago. Lee had put that up there, but in the E-mini think tank, as I mentioned, if you are not a member right now, you can join. There's either a monthly option for a subscription, or you do as a quarterly subscription. If you do the quarterly subscription, you get to try it out for 2 weeks. We don't even charge a credit card, so there's no risk. You just check it out, and if you like it, then you let the billing go and you continue to enjoy the product. If it's not right for you, you just let us know. Cancel, no harm, no foul. You don't have to worry about getting money back or anything like that. So with the E-mini think tank, we meet 3 days a week, as I was saying. And actually, I haven't updated this. I was looking for the numbers from this month. But what happens is every session when we get together, I put out trade ideas. Just trying to find one of the recent ones. There we go. And, you know, I had these trade ideas. This was from Wednesday of last week. So I put out the trade ideas. You get the trade, I'm sorry, the security, the time frame, the entry, the stop, and, you know, basically how much you are putting at risk for every one contract. Now, remember, nat gas, that actually has a micro or a mini you could trade. So you could reduce the risk there. Matter of fact, I don't know if I did on this one. Yeah, right here, Bitcoin. You could use the 60-minute time frame and either trade the full-size Bitcoin or the micro Bitcoin. I even give you the symbols there. So you can adjust your risk based on the type of trades you want to take. So some people will only take smaller intraday trades, say on a 15-minute or 5-minute chart. Other people would look for the 4-hour or daily trade ideas and trade the big picture. It's entirely up to you. But I've been pretty successful with those trade ideas and what we do in the session. This is this month so far. We're actually positive for the month. I haven't gotten everything tracked. And you can see there are losers. You know, I don't win all the time. As a matter of fact, my win-loss ratio is pretty bad this month. Is this right? That's not updated. The average win, average loss. Yeah, let me see the previous month. That's September. There's Think Tank. There it is, September. But, you know, we track all these trade ideas or hypothetical trade ideas that we could take. And I don't know if there's still one open. I got to check on that. I had 19 winners, 10 losers last month. So we won 65% of the time. But overall, it was a very successful month. Winners and losers, they happen. But just following simple rules, you can see I'm not afraid to show the losses. We get stopped out sometimes. But that's what we do in the E-mini think tank 3 days a week is I find these ideas. We go over the ideas because I present them in that format you saw with the longs and shorts. And I explain the trade ideas as well as strategies that we use in the markets on a regular basis. So I got to get going here, but if there's any questions, please let me know. If you're interested in learning more, we put the link up there for you. So in the chat, you can click on that and give it a try if you're interested. And I want to thank everybody for being here. Have a great weekend if I don't see you beforehand. If you're in the E-mini think tank, I'll see you Monday morning. So until then, everyone trade safe, trade well, and take care. Thank you.